Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. My name is Zhong, and I'm standing in for Daniel Lam, who is still competing in the Chess Olympiad in Hungary. The September FOMC meeting outcome, which is due in less than a day, is probably at the top of most investors' mind. It's almost a foregone conclusion that the Fed will cut interest rates, potentially speeding up the global trend of monetary easing. The broader markets is also in concurrent with that view. However, a part that the markets can't agree on is the size of the cut. 25 bips or 50 bips. At the time of recording, the Fed Fund Futures markets is pricing in around 40 bips of cut, suggesting that the latter is a likelier outcome. On the other hand, the consensus forecast by the economists is for a 25 bips cut. On this debate, I would like to offer a few insights. Firstly, while the Fed rarely surprised the markets, we have been here before. A close parallel is the September 2007 meeting. Ahead of that meeting, there was a similar debate around whether the Fed starts the easing cycle with a 25 bips or 50 bips cut. Back then, market pricing gravitated towards a 50 bips cut in the days leading up to the meeting, which is what the Fed ended up delivering. The second insight is, based on the current market pricing, the surprise component of this coming Fed rates move is the largest in over 15 years, regardless whether the Fed eventually go 25 or 50. The third insight is the growing market expectations for 50 bips cut in this coming meeting appears to stem from a few press reports. Historically, leaking information to the press in an attempt at telegraphing larger policy moves is not unprecedented. Lastly, none of the Fed speakers communicated a 50 bips cuts before the blackout period. That being said, while the magnitude of this week's cut would have short-term market implications, it is probably less crucial than the forward guidance, especially from the Powell press conference. We will focus on the dot plot to glean the pace of the cutting cycle and the eventual neutral level. The market pricing is suggesting 250 bips of cuts in the next 12 months. Any hawkish surprises to that pace of easing cycle could pose an upside risk to the US government bond yields. We will also keep an eye out for the updated economic projections, particularly the growth targets and the long-run unemployment rate forecast. That's all the time I have for today's podcast. If you enjoy this podcast, please help us to like, rate, and share it. Thanks so much for tuning in, and speak to you again tomorrow.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.